Hello everyone, my name is Kamal Manocha. I present PMS AIF World. First of all, warm welcome to all of you who have joined on Saturday afternoon. The topic today, that we want to cover is a very popular product, Marcellus Consistent Compounders. I think one of the most popular PMSs that we have seen over last 5 years, is Marcellus Consistent Compounders. It started in 2008 December after one full year of full-fledged correction that happened in equity markets, especially after a very good year, 2017, where small and mid caps had done really well. And then after that, in 2018, capital gain tax was introduced and many things happened. And that obviously led to the fall in confidence of investors. Exactly at that point of time, Marcellus had launched consistent compounders with a philosophy which was kind of promising that there is a risk of a government bond, but returns which can compound wealth like 7 to 10 times over 10 years, and obviously with a consistency kind of in between it. So that was very attractive proposition, and that made it a very popular product over last 5 years. However, obviously during COVID period, this product did really well because those were pessimistic times and consistent compounding businesses did fall less. But over last 2 years, the portfolio has been underperforming, and that is the context that we want to cover in this webinar to understand from the fund manager and founder of one of the founding team members of Marcellus, Mr. Rakshit Ranjan, on what's happening in the portfolio, what is the guidance for clients and investors who are logged in and who are invested in this portfolio over next, say 1-2 years, especially when world is heading towards recessionary times. So I do believe that during pessimistic times and recessionary times, some of these businesses where Marcellus is invested really actually outperform. But I would want to hear it from the founding team member of Marcellus on what is the way forward and guidance for our clients and investors. So in the first part of this webinar, we'll cover that in form of a presentation, which could be for 30 minutes, and then in the subsequent 30 minutes, we'll be taking all questions from the audience. So I would request everyone who is logged in, whatever question you have on your mind, particular to the strategy, guidance, expected returns, or underlying stocks, whatever genuine questions will be you will be asking, wanting to ask, we'll cover them in the second part of this webinar. Welcome, Rakshit, to this webinar, and thank you for giving us time to do this on Saturday afternoon. I have set the context for you, and over to you. Looking forward to understanding and learning what I think needs to be learned at this point of time regarding Marcellus constant compounders.
Sure, thanks, Kamal, and good afternoon, everyone. Thank you for dialing in. So, Kamal, you said the context quite nicely. Thanks for that. Let me just make a few modifications to that context. So yes, it's absolutely true. Whenever you see concerns on broader fundamentals of the economy and hence of the constituents in the stock market, that I repeat, whenever there are concerns on fundamentals of the broader constituents of the stock market, high quality businesses, they benefit more from the adversity, and hence their share prices are significantly resilient. That is what we have seen during the COVID times, as you mentioned. That is what was visible during 2018, Island FS crisis. Prior to that, as you mentioned, the period where capital gains tax was introduced, 2016, there were 2 or 3 instances of market correction, etc. I disagree that Indian economy is headed for a recession. Indian economy, let me repeat, is not headed for a recession. Okay, there are no macro headwinds around generating volume growth, revenue growth that we are seeing at an economic level, right? It is quite interesting to note that typically once in 8 to 10 years, you see quality as a basket not perform as share prices, even though they do perform as fundamentals. And hence there's a massive disconnect between fundamentals and share prices. It's a far more infrequent event compared to the COVID types of corrections where quality delivers resilience, right? Quality delivering resilience during broader macro concerns typically occurs in once in 2 years, once in 3 years. But this sort of a phenomenon which we've experienced in the last 12 months, we have experienced this after a good 10 odd years. 2013 was the last calendar year where I remember this had happened for more than 12 months. And prior to that, 2002, 2003, it had happened for as long as 26 to 28 months. That was pretty long, right? So it's infrequent to see this sort of a dislocation, disconnection between fundamentals and share prices of high quality businesses. And it is not specific to any one or two stocks or one or two industries or one or two portfolios. This is across the whole basket of quality what we've experienced, right? Now, what do we expect out of the say next few months or years? Let me see if I can project. Okay, I hope you can see the slides now. So I'll use 3 or 4 slides rather than extending this presentation to 30 minutes. I'll probably wrap it up in 15 minutes and open it for Q&A. So let me set the context like this. Hang on. Right. So this is how the fundamentals of our portfolio companies have performed. In the 9 months of FY23, you can see revenue growth has been around 20% year on year. For the 9 months of FY23, earnings growth has been 24% year on year. There are a few negatives and happy to talk about them, but broadly speaking, including those few negatives, the 20 to 24% fundamental growth at revenue and earnings level respectively has happened in the last 3 quarters. Now, if this was on a very weak base, you could have said, well, this is not like for like. But interestingly, FY22 was another year of 23% year-on-year revenue and 27% year-on-year profits, right? So on a strong base of FY22, in FY23, our portfolio companies have delivered 20 to 25% revenue and earnings growth on a year-on-year basis, right? There is no concern whatsoever that we are headed for a 10% revenue growth and a 15% profit growth for the next 3 years, 5 years of this portfolio. In fact, on the contrary, I would actually say the events of capital allocation across these portfolios in the recent past have actually suggested that fundamental growth compounding will be an accelerated variant of what historically used to be the case. Historically, we didn't deliver 25% earnings growth. Earnings growth used to be 18 to 20 in this portfolio. Free cash flow growth used to be 24, 25. And free cash flow growth is likely to be, in fact, even healthier given how capital allocation decisions have happened. So that's on fundamentals which have been reported. Now, how does that then link into the longer term evolution of fundamentals of this portfolio? So the top 4 rows are for the CCP portfolio. The bottom 3 rows are for Nifty 50, right? First and foremost, cash generation, massive delta, right? I don't know if you can see the cursor on my screen. Anyways, so the first and foremost bit, return on capital employed, a good 20% gap has been sustained for pretty much every year between the ROCE of Nifty 50 and the ROCE of our portfolio companies, which most of which are part of Nifty 50, right? In effect, you remove our portfolio constituent from Nifty 50, the rest of the portfolio has probably delivered less than 15% return on capital, right? Now, that's a gap which is not shrinking. In fact, in the more recent years, you can see the gap has been either sustained or widened. Secondly, when it comes to profit after tax compounding, there is a good 10 percentage point gap in that growth rate pretty consistently, right? Somewhere it's 10, somewhere it's 9, somewhere it's 15. But there is a good 10% odd gap between the profit after tax compounding of CCP companies and the profit after tax compounding of Nifty 50. And finally, when it comes to free cash flow compounding, our portfolio companies have delivered on average 4% higher rate of free cash flow compounding compared to their profit after tax compounding. And that's a very, very important phenomenon to note, that when you look at valuations, and I'll come to it in a minute in the next slide, on a price to earnings basis, remember price is a reflection of free cash flow growth or free cash flow expected in future years for a particular company discounted to today's value. That's the price. That's the value that the market is ascribing to a business. It is not profit after tax in future years discounted to today's date. That is not the definition. The definition is free cash flows, right? For a typical business, free cash flow compounding would be very similar to profit after tax compounding. For Nifty 50, in fact, free cash flows are on aggregate negative. As a result, we don't have the free cash flow line item in the bottom 3 rows. But when you look at this portfolio, free cash flow compounding has been consistently higher than profit after tax compounding. What that does is it effectively tells you that when you look at the PE multiple, just be conscious of the fact that the numerator is being driven by free cash flows at a higher rate of growth compared to the denominator, which is profit after tax. It doesn't happen for most companies, I repeat. It does happen for CCP companies very consistently because they crush the working capital cycles incrementally. They expand asset turnovers pretty consistently, right? So that's about the fundamental comparison between our portfolio companies and the benchmark. As long as these gaps are wide and sustained, the gap between CCP's fundamentals and Nifty 50's fundamentals, you should not have any concerns on the ability to beat the benchmark, right? Having said that, as I mentioned, last 12 months, there's been a disconnect. So let's see, look at all of these messages, including the disconnect, on a few simple exhibits. This is the weighted average PE multiple of the CCP model portfolio. Now, at no point would we have, to begin with, at no point would we have seen the PE multiples get to a level where we found these companies overvalued. As a result, we keep buying whether the PE multiple is 40 or 45 or 50, right? At specific stock levels, certainly yes. There have been some rare instances in the past in such a portfolio where the market fully factors in the greatness, in which case we've not bought into those companies or exited from them. But what's very interesting is that the price to earnings multiple today is about a 30-35% lower level than where it was exactly a year ago. And this is despite the businesses actually going through massive upgrades and being transformed, right? Now, some of you might look at this and say that, look, it is true that today's price to earnings is lower than where it was a year ago, but today's price to earnings is still the same as where it was 5 years ago. So has it really become really cheap in terms of PE multiples, which is where that gap between free cash flow compounding and earnings growth comes into perspective. If you look at this slide, right, this slide will be part of our forthcoming newsletter. You'll read more about it there. This slide shows a very interesting combination of two lines. The solid line is 5-year cumulative. Why do we take cumulative? Because we don't want to reflect the 1-year intense volatility in free cash flow. So when you take 5-year cumulative and then do a roll and index it, you're effectively getting the rate at which free cash flows are compounding. What is quite interesting is right from 2015 to 2019, these two lines were moving hand in hand, right? And today, the dotted line has gone significantly below the solid line. We haven't plotted the solid line for the 11 months to 28th Feb 23 because the free cash flows are yet to be reported, but profit after tax have actually gone up at 24% this year. And on top of it, there's a very low base of free cash flow from FY22. So you'll see, in fact, when the free cash flows get reported as on 31st March, there's going to be a comfortably more than 24% growth in free cash flow growth of the CCP portfolio. So the solid line will be extended upwards at a pretty sharp slope, and the dotted line is below that, right? So that's in a way to contextualize where do we stand today. Why are we not concerned about fundamentals today? Having said that, when it comes to say specific stocks, happy to talk about them. So let me touch upon maybe 2 or 3, and then I'll leave it to you to ask questions to go deeper. Page Industries, right? An example of a stock which in our portfolio has corrected by 30%. Page has compounded its revenues in the last 3-4 quarters at a rate significantly higher than what used to be the case prior to COVID, right? And these are 3-year revenue CAGRs, so that we are not talking about sort of seasonalities or low base, high base, or this temporary factor, that temporary factor, etc. So these are all 3-year CAGRs. 3-year CAGR in the last 3-4 quarters versus 3-year CAGR prior to COVID. There is a good 3 to 4% step up in those growth rates, right? That step up is largely all market share gains, because when you look at the more near-term, more recently reported quarters, in the third quarter, there wasn't any company other than Jockey to report a positive revenue growth in the listed innerwear space, right? Lux, Rupa, Dollar, they all had minus 30 to minus 40% YOY in their revenues. For the 9 months as well, Jockey reported plus 38, and all the others reported either flat to down 25, right? That was the 9-month FY23. This is a market share gain run rate, which is far stronger than what usually was the case previously. Remember, the stock is down 30%, yeah, maybe 35. This is how the acceleration in growth, the gain in market share has been supported by the underlying business evolution. So the number of distributor touch point, dealer touch points, they have more than doubled in the last 3-4 years. The tech investments have made the whole business far more automated. That has actually led to working capital cycles go down for the distributors as well as for Jockey. Something that you can actually validate by speaking to the distributors and understanding how much higher return on capital they are generating thanks to the drop in working capital cycles for them. And in addition to that, a lot of automation in the recently opened sort of Odisha plant, some backward integration, so on and so forth, right? It's a business which is able to handle far wider range of SKUs, right? Those of you who keep a track of, let's say, the women's innerwear product portfolio of Jockey, to begin with, until a year ago, Jockey used to offer only comfort-oriented women's innerwear products. Today, they are offering the whole range. Until a year ago, stockouts in the channel, unavailability of your desired size, color, style, etc. was very frequent. Those problems have been fixed. And this business is very wide in the kinds of outerwear products. You can call it loungewear, leisurewear, etc. Which again is a very SKU heavy product category. Jockey has successfully expanded into it and made deep impression in the channel and the customer base. Remember, it's very difficult to do outerwear because you might When it comes to innerwear, you might want to buy 3 or 4 pieces of innerwear which look exactly the same, but you won't buy 3 t-shirts or 3 track pants which look exactly the same, right? So the number of SKUs are phenomenally higher, and hence handling that is one of the biggest challenge, which is why you've not seen a men's innerwear player successfully expand into women's, and forget about just women's, also expand into outer. Right, so that's what this business has transformed itself into. But the share price is down 30%, nothing but an opportunity to buy more. This is Dr. Lal Path Labs, right? One of the larger allocations in CCP, and quite clearly a disappointing share price performance in the last year and a half, where it is down roughly 50%. Bulk of the organized diagnostics industry is in the listed space. So when you add Dr. Lal, Metropolis, Tharocare, SRL, Vijaya, and there are a couple of others like Aarti Scans, Anand Diagnostic, Suraksha from Calcutta, Bangalore, Tamil Nadu, etc. You add all of this together, it's roughly 7,500 crores out of the 8,000 to 9,000 crores of organized diagnostics industry. Dr. Lal is the fastest growing player. The 3-year revenue numbers you can see non-COVID. This gap is a good 4 to 5% versus the number 2 player Metropolis in terms of rate of growth, and significantly higher compared to others. Now, this is a company which, as part of the organized industry, offers a massive value add compared to the mom and pop labs and the unorganized players typically, right? So organized gaining market share over unorganized is a structural story here. It will continue for the next 10 to 20 years. The width of the menu, the convenience factor around various types of interfaces available to the customer via organized players, which are not available via in unorganized, are the reason for this shift of market share from mom and pop to organized players. So organized will continue to gain. It's only 10% of the overall industry. And within organized, Dr. Lal is growing at the fastest pace. So the big question, why is the fastest growing player also growing at only 12 to 13%? India is not a fully penetrated industry in diagnostics by any means. So shouldn't the growth rate be higher? And the answer is yes, it should be higher. What has happened in the more recent quarters is also there are a couple of temporary factors which were there. Mom and pop labs got an oxygen supply in a way through the cash windfall gains from RT-PCR tests and the footfalls associated with it during the Omicron, Delta, etc., all of those waves. That has led to the drop in market share of mom and pop labs decelerate a bit for a temporary period. That oxygen supply is running out, and now we'll be back to the rate at which market share used to be gained previously. On top of it, there used to be a lot of price competition from new entrants, such as, say, a Farm Easy, M-Fine, Tata 1mg, Lifecell, Healthians, Redcliffe, etc. Right? Barring a Tata 1mg, everybody else is either wound up or there are initial signs that they are winding up. When I say winding up, they might or might not completely shut shop, but they are receding in their growth rates. Some of them are declines, and most of them are not willing to burn more cash to fund new customer acquisition, so on and so forth. So that's how we see the industry dynamics evolving. The fastest growing player is growing at 12 to 13% in the last 3-4 quarters. But there's enough reason to believe why that growth rate for the fastest growing player will not be just 12 to 13% in the longer run. At a company specific level, this firm is significantly differently positioned compared to what it used to be previously, whether it be in its D2C capabilities, D2C offerings. So remember, Dr. Lal never used to do even search engine optimization. Those of you are aware. It requires a little bit of a mindset to understand how to come on top of a Google search when somebody searches for a particular test or diagnostic as a keyword or something. There was no focus on this direction, and this firm has undergone initially a few challenges to reorient their tech mindset, but then subsequently successfully doing it. Initially, they got a few people. Not everybody stayed on, because in 2020, 2021, the senior management's mindset had itself not fully evolved towards tech, etc. All those are problems of the past now. In fact, now in the last 6 to 9 months, when you look at the initiatives that they've launched, it's remarkable, right? A very quick example: when it comes to B2B, they are offering API integration of their laboratories with the hospitals. That allows the hospitals to get real-time updates on diagnostic tests for patients who are waiting for the diagnostic report to kick off the treatment via a doctor who's also waiting, right? And these API integrations are the first of their kind. Nobody used to provide them. That's one example. And a lot of other stuff. In addition to that, the Suburban acquisition, which is progressing quite smoothly now after the first 1 or 2 quarters of sort of integration related steps. It's moving forward now. It should add even more muscle to the momentum. More recently reported quarters, it's been about 40-45% growth in Suburban Diagnostics is non-COVID revenue year on year, so on and so forth, right? So that's what this firm we expect will deliver. Share price is down 50%. This is nothing but an opportunity to buy more, which is what we've done about a year ago. We doubled our exposure to Dr. Lal. I'll take a third example and then stop, because these three, I think, were the most topical in most FAQs that we've received. Divi's Labs. This is another company which is sort of down 40-45% from its peak. Now, for those of you who understand this business, half of it is custom synthesis for patented drugs. That half, which is custom synthesis for patented drugs, is very volatile from a quarter-on-quarter basis. The reason for volatility is that, to put it very simply, patented drugs, patented molecules will have a limited life to the contract, because once it is off patent, then it might or might not lead to as healthy a revenue in quantum per unit manufactured, because the prices drop by anywhere between 70 to 90% once the drug goes off patent, and there are other manufacturers also who come into competition, and hence at any point of time for a particular quarter, Divi's revenue growth is a net effect of existing products, some of them going off patent and hence contracts ending or reducing in revenue quantums, and new contracts getting added, right? There'll be quarters when new additions are far more than existing expiries. In those quarters, you'll see a very high growth in revenue, and there'll be other quarters where new additions are lower than expiries, and those quarters you'll see declines in revenues. It's quite interesting to see. This is a 20-year chart of Divi's on a quarterly basis. Throughout the last 20 years, there are actually very, very few quarters where the growth rate has been around the 20% mark at a quarterly level, despite the fact that in the longer run, Divi's has compounded revenues at around 20%. But very few quarters have a 20% growth for Divi's. Most quarters are either 40-50%, or they are -10, -20, -30%, right? That's the lumpiness of Divi's business from a quarter-on-quarter basis. The share price then also goes through ups and downs. Unfortunately, we can't predict the lumpiness in foresight, and hence we can't predict the share price reactions in foresight. At the same time, the share price doesn't wait always for the revenue growth to recover before the share price recovers. And many at times you can see in some of these encircled periods, the share price recovery happens before the revenue growth recovery goes through, right? We are in one such revenue decline phase. This is temporary. Why do we believe that? Not just because of the historical chart, We've spoken to the ecosystem of buyers for divis, largely 7 big pharmas. They contribute to about 90% of revenues for divis. We've spoken to many of such people in the ecosystem of divis as buyers, and we've got very good clarity on where divis stands vis-a-vis their competitors. There are actually only 2 divis. Lonza are, broadly speaking, two companies which are in the top 2 priority list of all big pharma for contract manufacturing outsourcing. So that's where the conviction is coming from. And in divis as well, somewhere in November, we almost increased the position size by double, as in there was an almost doubling of the position size, a little less than that we've done in Divis Labs' case as well. Next 1, 2, 3 quarters, there are new contracts getting added. Many of you who track this company might be aware of some of the announcements the management has made. There is a capex plant approval which was pending, land acquisition approval which was pending in Kakinada, which also they have got. So the pipeline from that aspect is also not blocked anymore. So a variety of reasons, and hence our conviction stays. I'll stop here. There's a lot more to talk about, but Kamal, over to you. Happy to take questions.
Sure, Rakshit. So you can kindly stop the presentation.
Okay.
Perfect. So I think, presentation went on for 30 minutes, and as it was expected. So you have covered.
I covered probably some of the Q&A.
Right, some of the questions have been covered, so it's good. So, one of the topmost questions that come to my mind, that despite all the hard work, research, numbers, ROCs, all these attractive, over last 2 years, the portfolio has performed 6% versus Nifty performing 15%. 3 years, portfolio has performed around 10% versus Nifty performing 15%. So why is it, there is so much underperformance? 1 or 2% of underperformance is understandable. But for last 3 years, there has been a very deep underperformance. Though obviously we still have a lot of conviction with regards to the underlying businesses that are being held and the philosophy. And that conviction I can see all the more when you are doubling your weights in some of these underperformers. But how do you kind of, rationalize this prolonged underperformance over last 3 years?
Right. So honestly speaking, I mean, this underperformance is particularly the phenomena of the last 12 to 15 months, right? So let me. Okay, I'll have to. Can I project my screen somehow in this interface, or
you can? On the top, you will see there are 5 buttons just on the top on the screen. You will find the middle button says, you can
turn screen share on.
Yes, exactly.
Okay. So just to remind, because you're talking about a period as long as, so this is a performance chart which obviously is very powerful, but it wasn't a 3-year-old performance chart. This is 1.5 years ago, right? 1.5 years ago, whether you look at the since inception, which was almost 3 years by then, or whether you look at the 2 year or 1 year or shorter than a year, there was no disappointment of either absolute returns or relative returns. The blue bars were CCP returns, right? All the underperformance that you're talking about has happened in the last 12 to 15 months. It is incorrect to say that consistently for the last 3 years, we have underperformed. Obviously, because the last 12 months, there has been a 10% underperformance. So even the last 2 year or a 3 year comparison standing today, when you look back, it is adversely affected, which is the number you are correctly spotting, but it's not the right conclusion that for the last 3.5 years, this fund has underperformed. So the more relevant question is what has happened in the last 12 to 15 months and whether that is temporary or not. उससे पहले की कहानी अगर किसी को लग रहा है कि 2021, 2020, 2019, 2018 में ये फंड अंडरपरफॉर्म कर रहा था, तो वो मिसरिप्रेजेंटेशन ऑफ हिस्ट्री है. Now, last 12 months, 15 months, they have been, you can break it down into 3 parts. Part 1 was Jan to June 2022. Russia-Ukraine war led to commodity prices rising up, and commodity producers massively benefited. So the likes of Hindalco, Tata Steel, JSW Steel, etc. If you didn't hold these stocks in your portfolio, you underperformed. We didn't hold them, we underperformed. But that was a typical once in 2 years, once in 3 years, short period of irrationality, which then usually reverses. And it also reversed. July, August, September was the second phase of the 3 phases that I was talking about, where this fund, it delivered a 20% absolute return and a 9% alpha over Nifty 50. The entire week absolute return of Jan to June 2022 and the entire underperformance of Jan to June 2022 got reversed in July, August, September, 3-month period. So the first phase was totally offset by the second phase. Had we had the same presentation sitting in September end, your 1 year, 2 year, 3 year charts were not at all reflective of weak absolute or relative returns. Then came the third phase, which is October, November, December, and first half of January. PSU banks, cap goods, such kinds of stocks, particularly the PSU banks and PSU related companies, which have done phenomenally well, right? The quarterly NPA progression of SBI from data perspective is suggestive of a complete turnaround in credit quality assessment capabilities of State Bank of India. And the same, interestingly, at the same time for Bob, for Union Bank of India, for X Bank, Y Bank, Z Bank, as long as it's a PSU bank, right? Imagine how coincidental it should be that the credit teams, the collection teams, the operational efficiency teams of all PSU banks all together turned around, right? Massive, right? So that is what has been reflected in the reported numbers. We don't think that's sustainable. We don't buy PSU banks because we don't believe that PSU banks are higher in quality than HDFC Bank or Kotak. We don't think in the next 10 years, these PSU banks are going to gain market share from HDFC Bank, Kotak, etc. And hence, we stick to our guns. We keep buying HDFC Bank, Kotak, Bajaj Finance as the 3 lenders in our portfolio, right? In the last 4 months, if Nifty 50 gets pulled up by some of these stocks, which we don't own, and hence the underperformance, this is yet another temporary phase. Again, we don't know whether this phase will last for 1 more month, 3 more months, 6 more months. But what we do know is, sitting 2 years out, we will not be looking at this sort of a fundamental momentum in some of these companies that have reported results recently, whose share prices have rocketed upwards, being sustained. That's the reason, that's the hypothesis, that's the belief on which we are investing. And hence, yeah, I mean, I totally agree. Because of this, the last 1 year, 2 year charts, they look pretty weak, particularly in a relative way. And it is testing patience, because usually, as I stated in the beginning of this presentation, usually high quality companies' share prices remain far more resilient during difficult times. Last 6 months weren't difficult times by any standards for economic profit reported by various companies, or even reported profit, just let me put it that, by various companies. India is not undergoing a massive deceleration in GDP growth.
Sure. Okay. So I think, put your point fairly well. So yes, underperformance has come over last 12 to 15 months, and that is, spoiling the CAGRs of 2 years and 3 years. I understand that. Now, the bigger question is that, the thesis of consistent compounders says that, over years, stocks like Nestle, Bajaj Finance, they have compounded over 20% plus, and hence, obviously, they have created a lot of massive wealth. But when you go back to history and see, these 20 years of performance, obviously these stocks have moved up from being maybe a 10,000 crore business to a, say, 5 lakh crore business, right? So that is how that progression has happened. But now at present, your portfolio has 80% large caps. So, portfolio's average market cap is quite high. So from that point of view, if anybody is holding this portfolio expecting that he's going to get consistent compounding of, say, 18-20% over next 5, 7, 10 years, how do you rationalize that?
Okay. So first and foremost, the underlying assumption in this question is that larger companies are close to saturation points. That is absolutely incorrect. Here is the data. HDFC Bank is 10-11% market share of credit in India. At any point of time, the largest bank in India, the largest bank in China, the largest bank in UK, US has had more than 20% market share. So just saying that a bank, if it reaches 10% market share, it's approaching saturation to begin with is incorrect. Particularly when you know who the competition is and why the competition will keep bleeding market share to HDFC Bank and the likes. Bajaj Finance is 2.5%, 3% of market share, right? It is not a consumer durable lender where you say, well, don't look at the whole market. It does home loans se lekar consumer durable lending, sab kuch. Titan is 6% market share in jewelry. एक जमाना आया था जब पीसी ज्वेलर, टीबीजी, कल्याण, जॉय लुकास सब बहती गंगा में हाथ धो रहे थे, right? There is no hope of Titan hitting saturation point in jewelry market share gains. That's another too large allocation. Dr. Lal Path Labs, as I said, organized diagnostics is 10% of the market. I agree Dr. Lal is not a large cap and hence doesn't directly relate to your question, but it's also one of the larger positions. That's why I'm talking about. Dr. Lal's market share in the entire diagnostic industry as a result is only 5%. It's a little over 1/3 of the organized industry, right? There's no point of saturation hitting Dr. Lal anytime soon. Another large position, Page Industries, again, not a large cap, but million miles away from hitting saturation points, right? Menswear, where the market share is the highest for Jockey across all the categories, even their Jockey's market share in the entire industry is only around 20 to 25%. Women's wear, so it's around 10 or maybe less than 10, and loungewear, leisure wear is even lower, right? Why is all this happening? I mean, at one level, these are large companies. At the other level, they are very small when you look at the market share points. This is simply because the industry sizes that we're looking at are significantly large and a massive unorganized to organized shift is yet to happen, right? We are not in a saturated economy. We are not talking about United Kingdom as the addressable market, and hence a large player within 20 years hits saturation, right? Now, the only exception to all this is, say, an Asian Paints. Asian Paints has 55% market share. That cannot exceed 70-75% when particularly the number 2 player Berger is not letting any market share go to Asian, right? What gives us the conviction on Asian Paints to continue compounding free cash flows at 20% plus is the fact that this company is no more just a paint business. And the non-paint businesses are not just experiments. They are successful, profit-generating adjacencies, peripheries that they have entered into. Something like a home decor, for instance, is a 10 times larger market than paint itself. Now, jury is still out whether they will make it a massively successful venture or not. But when you look at their white putty, primer, waterproofing as adjacencies that they've gotten into in the last 5-6 years successfully, even without home decor, for longer than a decade, you can see the runway for growth being very healthy before you hit a saturation point where growth rates can't be 20%. Right? So that's in a way, I would say the way the question should be answered, that you are in no way looking at these large caps compounding at 5% and the small caps compounding at 30%.
Sure, Rakshit. So I think, to kind of conclude your answer, you basically are trying to say that obviously all these companies are so well moated and in industries where there is a huge further scope of penetration and increase in market share. And obviously, these companies will continue to keep compounding over next decade as well. However, the question is that when India's economy is also growing, as you also mentioned in the beginning, that we are not at all in recessionary times. In fact, everybody believes that we are headed for a rise of India's economy from say 3.8 trillion to say 5.5 trillion over next say 5 years. Obviously, in this progression, many mid caps will become compounders and many mid caps will become large caps. Right? So, we have seen historically all the data that you have shown of Page Industries, Titan, it's historical data because of the growth in the business in the past where these businesses got discovered. I have not seen many even large family offices owning stocks like Titan in last 5 years. It was maybe Sunjunwala and few more I would say wise investors who could see that and who added Bajaj Finance or HDFC Bank or Titan much earlier. But now many I would say funds are holding these stocks, and obviously considered compounder is also holding. But the issue is many other funds are holding many other stocks as well, which could turn out to be future compounders. But CCP is not owning some of those stocks. In fact, you are just increasing your weightage in some of these existing stocks only, which is what led me to raise one poll to the audience where I mentioned that what is the concern to you in the portfolio, and the top voted item is holding on to underperformance with least changes, with kind of not much changes in the portfolio. That's what people kind of feel. It may turn out to be a jackpot, with your conviction, and I would wish you for that, because I myself invested in most of the stocks, including Dr. Lal Path Labs, Page Industries, in my own personal portfolio. But the real question that comes is that for next 5, 7, 10 years in the growth phase of economy, why not dig deep and find out future compounders and balance out your portfolio with some of the futuristic Asian paints? Some of the world is changing, India is also changing. There could be many more stories which will compound wealth. Why would you only stick to these 14 names? Why would not diversify and maybe add a few more names in the portfolio? What is the answer, to this particular question?
Okay. So you, in a way, I would actually first of all say you have asked probably 5 questions in one question. So let me see if I can actually shred it into the 5 constituents and answer them one by one. First and foremost, you're saying discovery factor, smaller companies growing faster than larger companies. No disagreements there. That is why Marcellus's Little Champs portfolio is expected to and has in the past outperformed over CCP. That is why Marcellus's Rising Giants is expected to outperform over CCP, because there is not just a discovery factor in a Little Champ. The Little Champ is also at a very nascent stage of operating efficiencies. Forget about just market share gains from a smaller base, right? So I'm absolutely with you that high quality smaller cap companies will outperform high quality larger cap companies, right? Second point, you doubted on the absolute return CAGR of 20% given the size. The answer to that is simple, boss. I am not saying CCP will be the fastest growing portfolio performance. In fact, I'm saying in our own stable, Little Champs will do better than CCP. But if you want the risk profile, which is probably the lowest risk to fundamentals and hence to long-term capital, that's where Little chance is a little higher risk, high return than CCP. So you make your choices. You want low risk, 20% compounding, do CCP. You want a little higher risk, higher compounding. Little chance is what we offer. I'm sure you have other options. So that's the second part. The absolute number 20% is nowhere hitting saturation, and that's the reason why we offer what we offer here. There's another implicit question within your long question, which is concentration of the portfolio. अगर ये बोला जाए कि 50 stock portfolio will beat a 15 stock portfolio, and then you say high quality is maintained across both the portfolios, तो कहीं कुछ गड़बड़ है सोचने में. 50 stocks will have a gradient of quality across the 50. 15 stocks will be the top 15 out of the 50. If you really have conviction in your fundamentals, 50 does not make any logical sense whatsoever. Okay. So adding new stocks just for the heck of it, कि यार ये क्या है, वही 14-15 स्टॉक लेके बोर हो गए, सेम नेम कुछ धड़कता भड़कता दिखाओ. That is not the way to make money in the long run. Now, coming to probably the fourth question within your one question. There is the underperformance का word आपने use किया अपने लंबे से question में एक. We have not changed anything to the list of stocks in our portfolio. That is a fact. We have underperformed in the last 12 months. That is a fact. The only way we could have avoided that underperformance was, first of all, downgrading the quality of fundamentals to buy those where share prices have done well, but fundamentals are not high quality from a long-term perspective. We will not do that. Secondly, figuring out when to do, even if you wanted to do this, as in when to switch out from this to that and that to this, etc., etc. वो तो बिल्कुल ही need a hand of God on your head, right? So, despite the fact that we've underperformed in the last 12 months and we have not made any changes to the portfolio, if you say a combination of these two things means that a great fund manager or a good fund manager should react to underperformance, downgrade quality barriers, and buy other stuff which is outperforming, I doubt. We won't do it. Now, having said that, is it the case that quality small caps have done better than quality large caps and we could have done something around? No, ऐसा कुछ नहीं है. I mean, our little champs has also in the last 12 months delivered more or less very similar versus RG versus CCP. And this is not just Marcellus. Even outside of Marcellus, you pick up a high quality concentrated portfolio. In the last 12 months, they have not beaten the benchmark because what has worked in the benchmark is not quality. And if the investor expects the fund manager to just keep chasing 12-month performance regardless of quality of underlying assets, first of all, the client is calling for disaster. It might not play out in 2022, but it will certainly play out in 25 or 27 or 29 or thereafter in the long run. Capital erosion से ना recover करना बड़ा मुश्किल है if that capital erosion is permanent because the fundamentals eroded. Right? वो वाले जो fundamentals अगर Asian Paints के 50% decline हो जाएं, वहां से recover करना बड़ा मुश्किल है. Right? So we will not downgrade quality of stocks in our portfolio just to outperform in every 6 or 12 month time period. Right?
Sure, Rakshit. So I'll while I accept your answer partially, I will kind of give you larger context of this question. I'll give you the view that others have on constant compounders. I would say others means other learned people who understand stock market quite well. There is this understanding that last 10 years or last 15 years was an era of quantitative easing where there was too much liquidity in the system because obviously US had maintained almost zero interest rate for a very long period of time. And that led to that obviously that liquidity coming to emerging markets as well as in India. And at the same time, India's economy was not doing that well. Last, if you talk about 2010 to 2020, average GDP growth was around 3.5%.
Mhm.
Right? So during such times where liquidity was high and growth was less, there was less, I would say, risk appetite, more risk aversion, and large liquidity went to some of these consumer businesses, large cap businesses, and hence the valuations of these businesses became very high. But now, obviously, given that macro ecosystem, macro scenario, the entire consistent compounders thesis has worked. But now, over next say 10 years, we are in an era of quantitative tightening where liquidity has fallen. At the same time, growth has come up, and hence, in such an environment, it is impossible to believe that there will not be futuristic compounders. It is like saying, when that there are obviously going to be futuristic compounders in small and mid cap space, where there is more relatively attractive value and which you will be buying in LCP. Why would you not buy and blend your portfolio? I'm not saying and increase the size of your portfolio to 50 companies. I'm saying from 14 to 20 companies, at least add 3, 4, 5 companies. Why to keep increasing weights in Divi's Labs, or in Page Industries, or in Dr. Lal Path Labs? Why not identify 2, 3 such future consistent compounders, understanding that now macro environment has changed, and obviously in such an environment, some of these large companies may continue to keep doing their business, may continue to keep announcing their good earnings growth, but their stock prices may not increase, because obviously we are living in a value conscious environment, because liquidity is low and growth is back. In a growth era, investors worldwide would want to take risk and hence move towards some of those high risk stocks like mid and small cap, and may not want to just be into these consistent compounders.
Okay, so 3, 4 hardcore data points. Let me know if you think there is any debate. I don't see any scope for debate. Prior to GFC, a high quality portfolio like this, and we've given several examples in our books that we've published, a high quality portfolio like this beat most other portfolios. It beat the market by a 10% gap, just like it has beaten post GFC. GFC is the starting point of QE. QE is quantitative easing, which you were talking about. So hard fact number one, and please stop me and debate whenever you feel like. Hard fact number one, prior to GFC, high quality companies did better than anything lower quality, and a concentrated portfolio did better than a broader portfolio. So the era hasn't changed through QE during the noughties versus the last 10 years. What has changed is the crony capitalists used to have 4 or 5 year periods of share price compounding. L&T became 10x in 2 years, 2005 to 7. ऐसा जरूर हुआ था, वो होना बंद हो गया पिछले 10 साल में. वो आगे होगा कि नहीं पता नहीं. I will still never be able to pick out which are the 2 years when I should buy L&T and the rest of the time I don't, so that I get 10x in 2 years, right? So there is, in a way, the ability of a quality portfolio to beat the market and any other investment philosophy was the same prior to QE as it is during QE in the last 10 years. Okay? Again, stop me wherever you disagree. Huh? I'll continue. There are a few more points. Point number 2. This piece ki value discovery is what makes money. Stocks buying the same old will not result in healthy returns, etc. ये P multiple वाला कहानी, I'm sure people who are raising this question would have certainly looked at 2015 Bajaj Finance, 2016 Bajaj Finance, 2017 Bajaj Finance, 18 Bajaj Finance and said यार बहुत हो गया, ये कंपनी 10x हो गई है 3 साल में, 100x हो गई है 6-8 साल में. This can't continue forever. No other NBFC has done this. HDFC Limited has not done this. They are not getting the bank license. Falana, Dhikna, ye wo, right? And on the same argument जो आप अभी raise कर रहे हो इस question में, you have avoided Bajaj Finance as the same thinker, as an investor, right? You have also avoided Nation Paints. You have also avoided an HDFC Bank. You have also avoided, I'm sure, many other stocks. There are ways to build conviction in the sustainability of those share prices of these companies. Those ways are simple financial ways. That look, boss, In a rising cost of capital environment, cash generative company, in fact, undergoes deterioration in competitive intensity. In a falling cost of capital environment, all the Tata 1MGs and Farm-Easys of the world will enter. All Van Usens will be able to raise debt and Aditya Birlas will compete against Page. All fintechs will come in and compete against Bajaj Finance. All sorts of, and I go on and on, right? Pidilite ke bhi kafi competitor aa gaye the furniture market, right? The reversal of QE takes away all of that competitive pressure. हाँ, ये इग्नोर किया जाता है ये स्टैंडर्ड आर्ग्यूमेंट में कि क्वांटिटेटिव टाइटनिंग में you will see quote unquote value which is low PE multiples doing well regardless of quality, right? Another hardcore data point. So for those of you who have followed our recent new product launched by another team in Marcellus called Global Compounders Portfolio, either look at it via that lens, or many of you, if you are exposed to the US markets through some other fund managers, वो जो मैंने 3 phase का last 12 months period बताया ना, phase 1 commodity prices, phase 2 recovery from that, phase 3 PSU वगैरह. Phase 3 doesn't apply to global. It was India specific, right? ये PSU वाला सारा सागा जो अभी चला 4 महीने में. Phase 1 and phase 2 applied globally as well. As a result, from September, October onwards, if you notice, which are the companies that are doing better than S&P 500 within S&P 500? Are they not the same which also did well in the last 10 years? Or have they suddenly become debt-laden, weak, compounding, low PE multiple companies which have beaten S&P 500 in the last 6 months? Right? It's in front of us. It is still the high quality fundamentals, not necessarily low PE, which have done well in the last 6 months of S&P 500. So when you say globally investors are looking for more value, less growth, you are absolutely wrong. Investors will only make money if there is value via growth in a sustained way. वो जरूर है, if you are Howard Marks and running Oaktree as a sort of cigar butt investing, then out of a 10-year period, you stay invested in equities for 3 years because you bought cigar butts. For the remaining 7 years, you sit on cash. But saying ki, low PE, let me buy and hold on to it, doesn't work. And you can't keep finding low PE every year, doesn't work as a philosophy. On the contrary, a number of fund managers globally, because you picked up the word global and world investors, so I'm taking those analogies, whether it be Charlie Munger, whether it be Warren Buffett, they were investors during cost of capital rising environments in the last 6-7 decades. And during those cost of capital rising environments, Kachara did not do well over a 10-year period compared to high quality. So just, I mean, that's our view. We might be totally wrong, in which case, obviously, we'll be proven wrong in due course. But no, we don't see any reason why backing cash generative, deeply moated businesses, which are trading at a significant discount to their intrinsic value, will stop working as a way to make money. Over any 12-month period, there'll be other things which will beat our philosophy, etc. We are not in a rat race trying to beat every philosophy in every 12-month period. That is not our objective. Our objective is to keep compounding at, say, 18-20% in CCP and other products a little higher consistently over the longer run, regardless of what somebody else in the stock market is doing.
So, Rakshit, I think, we are also approaching at the end of this webinar. And, generally we do it for 1 hour. You have been able to answer, our questions, but honestly, there is far, I would say, fall in conviction of investors today, as it was for Marcellus CCP in the past. So,
True, no, that's true. That's true, and that's the reason for that is the last 15 months of performance chart.
but
The reason for that is not the fundamental prospects of, say, Bajaj Finance. That's
but the reason for that underperformance could be long term, in the sense that, as I kind of try to explain, that ecosystem is changing, and these structural changes could require you to make changes in the portfolio. So obviously you have shown your conviction and demonstrated that by giving data points, and we welcome that. But at the same time, it is important for you to kind of also highlight, as you said, that 18-20% return is what you're expecting from CCP. You talk about stocks like Dr. Lal Path Labs. You talk about HDFC Life Insurance. Obviously we know Page Industries has delivered good numbers. Titan has delivered
no,
good
but it's down 40%, Kamal.
correct. But still,
Do a poll. Are people happy having invested in Page via Marcellus in the last 12 months? Do a poll. Abhi jawab aa jayega. No, they're not happy.
I know that. That is why I have not.
That's the share price talking.
Yeah. So obviously, these share prices have kind of fallen because their valuations were high, and markets have turned value conscious.
I showed you the value
And
chart, but
yeah. And if this is to continue, then maybe there could be continued underperformance. That is the only fear, and that is where we need to understand from you that what is the future guidance. Are we just wanting to hold on to these stocks, or we want to kind of rebalance? Because it is difficult to believe that world has stopped producing new future consistent compounders. We know all these historical stories. They are today well discovered. They are quality businesses, but the question is about investing and making money, not just owning a Asian Paints that yes, it's the best company emotionally. I am owner of that company as a shareholder, which is a very moated business, but I have to make money out of that. And I understand we are not wanting to generate exceptional alpha, because the positioning of consistent compounders is not alpha. The positioning is consistency. But at the same time, we also expect returns like 17, 18, 20%. You quote 18, 20%. I say 17, 18% when we talk to our clients. In fact, even lesser than that, right? But the thing is, at the moment, returns are not even 10% in last 3 years. But yes, you rightly mentioned that these returns have fallen over last 1.5 years. So that is where there is this concern that this could be a beginning of a change in the dynamics of the overall positioning of these businesses as stock market perceives them, and hence it could require you to balance out your portfolio. That is the essence of the overall, I would say, questions that anybody would want to ask in the entire chat box if I was to read. Hence, in that context, the rebalancing in the portfolio, which seems to be missing, and too much, I would say, conviction and confidence on the existing consistent compounders is a reason for concern for investors.
No, fair enough. I mean, that's the view that you are articulating. That's the view that the clients are, probably your clients on this call, are articulating. As I said, you have a choice. You can pick up a fund manager who changes the philosophy every time there is a 12-month underperformance, or you have a fund manager who explains what they're doing, why they're doing. If that ties in with what you believe is the way to invest, then I think that's the marriage that you're looking for, right? I have given enough data points, and we can go around the circles again and again and again, but I don't see any reason why, due to interest rates, over the next 5 years, quality will not deliver as share prices. I don't see any reason why, right? The reason why you are articulating, Kamal, is the last 12 months of performance. The only way to have overcome the last 12 months of underperformance, as I have said, is buying a set of stocks which, I mean, they might give you a great 10-year out performance. I don't think so. And
from you, thank you so much, Rakshit, and thank you everyone for logging in today. Thank you for logging, on a Saturday afternoon, and this webinar went on longer. Generally webinars go on for 1 hour, but obviously, with CCP, it's had to happen because it's the most popular strategy. And we had more than 150 audience logged in for so long. Obviously, that talks about the expectations that investors have from you, Rakshit, and hence my good wishes to you, and hence my thank to you to kind of have joined today, given us your time, and answered all these questions. Ultimately, data wins, and data should win, and data would win. And my good wishes to you. Thank you, everyone.